The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Well, good morning, everyone. Welcome to Investor Resources September Market Update. Once again, I'm Perry Sykes. I'll be starting off this morning. Don Creech is with us as usual. Investing in general, and especially on Wall Street, it runs on numbers. Those of us that do investing, we track everything. We track everything we can think of, and then we just make stuff up to track. We track things that we probably know will never be important in any way, but we track them nonetheless. It's all numbers, and we try to look at it from as many possible ways as we can. Some are worthwhile, some turn out not to be so worthwhile. Wall Street has some bizarre rules of thumb, and right off the top, one of the ones that I think they are most obsessed with is a 1% market move, especially 1% down move on say the S&P 500. That tends to really get everybody's attention. And usually the thing missing is any kind of context. That's the part that would let people really think about this in a little clearer manner. 1% wouldn't move the needle in most decisions that we make. Just imagine heading out to a store. You're out looking for some new clothes. Your favorite shirt's on sale for 1% off. Would you buy that? Was that enough? Is that gonna get you moving? Probably not. You're probably not going to do anything for 1%. It doesn't seem like much at all. Not a reasonable thing to expect. But a 1% move in the stock market, and everybody's paying attention now. That's when you start seeing the red text show up. You start seeing the dramatic verbiage about the market's plunging, or we're nearing a crash. Things are terrible. On August 5th, the S&P 500 fell 3%, and more than one talking head was talking like the world was ending. It was a 3% move, 3%. Just not that big a deal, but Wall Street's not big on context. They're big on hyping things up and making things bigger than what they are. And we're gonna talk about that a little bit this morning. Look at what some of those things are. Understanding Wall Street's market math can be a little tricky. So we're going to look at some data here on the S&P 500. Again, that's the index of the 500 largest publicly traded U.S. companies. And we're going to, in investing, what's almost always true when anyone is talking about any data of any kind, it's what's your time frame? What time frame are we talking about? And the data we're looking at today is about 70 years, not quite. It's about 7 decades. So it's a nice large sample, but it's certainly not all the data that's out there for the S&P 500. It's from the 1950s on, and let's take a look at what some of these numbers mean, because we see them on an almost daily basis. 0.5%. 0.5%, that's the S&P 500's typical day. We often hear about when stocks are moving a lot, when things are really bouncing around, but 5%, that's kind of where the S&P 500 lives. Most days in the market are pretty boring. There's not a lot going on. The S&P 500 has gained or lost 0.5% on 53% of all trading days. That's the median daily change, about 0.5%. So if you're again, a little context, if you have $100 invested, 0.5% move is 50 cents. It's not a really big deal. That's what happens on most days. It's always important to remember when a big day does come up. It's like that's not most days. As you can see, the vast majority of days, about 0.5% move. That's about where the S&P 500 bounces around day to day. So that's a number largely that you could ignore. That 0.5% move is more or less just noise. And but the next thing you'll hear right away is that that seems like an insignificant change, but those small changes add up over time, and that's true. A 0.5% gain every day for a year, say, that's about 252 trading days. That amounts to about a 250% gain. If if the S&P went up 0.5% every day, of course, there's no year in the S&P 500 where it's even come close to that. The main thing to take away from that is that some of the market's quietest years have also been the strongest because they turn into consistent years, and that little move stays in one direction, and instead of becoming background noise, it's a trend that forms, and it's very slow moving, but it can still add up to a meaningful move. It just takes a lot longer. So that 0.5% move, go ahead and take a watch, see how it goes. Most of the time you'll see that's up and down and up and down, but every once in a while it'll trend up, or it just as likely it'll trend down, and then you can eventually get a larger move out of it. But that's kind of the daily average. A 1% day, 1% move on the S&P 500. Those qualify quite often as what get called the big days on Wall Street, when things are really out there moving around. Those are the days that can make the Wall Street pros sweat a bit. And believe me, they sweat just as much on the way up as they do on the way down. It doesn't really matter. Anything that moves the 1% in a day, now we're talking about things that don't happen nearly as often. And that's when people begin to start, especially individual investors, start to question their strategy. They start to question what they're doing. What do we, that was a big move. Are we on the right side of this or not? And it can really start to mess with your head, and that's when trading psychology really comes in. The S&P 500 has moved 1% or more in about 20% of days, so that's about once a week on average. But on a 1% day, now you're going to see the news fill up with pictures of those sad traders on Wall Street, on the New York Stock Exchange, and 20%, that average, it doesn't really apply here. Because these 1% returns, they're not predictable. It's not once every 5 days. It doesn't happen that way. Big up days and big down days tend to happen together. That's how we ended up being trend investors. We follow the money, we follow the trend, and that's one of the reasons why investing can be so tough on your brain. It's so tough on your psychological ability to make good decisions. Crazy periods, either up or down, they feel like they're going to last forever, and then all of a sudden everything goes quiet. And those calm periods, dropping back those 0.5% days, those are good and bad times for people's psychology towards a market, because people worry. They worry all the time, especially investors, and that no man's land space is not a place where people like to stay. It drives you to feeling like you have to do something. If you've had a big calm period and all of a sudden everything moves 1%, well, I need to do something. And that's often the wrong thing to do. Usually a single 1% move is not anything you should base portfolio moves on. But a lot of times, the fear and the doubt come in, or on the other side, overconfidence and greed kick in, and you really stop thinking rationally. You're way too nervous. You think you're missing a move, and all of a sudden you're changing things that even your own strategy says you probably shouldn't be changing. And that is one of the biggest reasons you need to have a rules-based system to keep your brain safe from thinking about things too much in the market. It's easy to get lost. There's so much data out there, and even if you're just looking at these percentage market moves, there's too many of them. Because you get the morning, where do we open? You get the halftime report. There is no halftime in the market, but you're still going to get one. You get the closing numbers. There's numbers all day long, and it can really work on you psychologically, and you can really start making some bad decisions. 5 to 10% moves. Now, sometimes those big 1% days, they can pile up a few days in a row, and suddenly you're in a sell-off. Especially on the downside, that's when these get very concerning. People usually take note when the S&P 500 has moved 5%. All the business news channels start running programming on, markets in turmoil. Podcasters like us, they sound a little bit more frantic. And once the sell-off hits 10%, then Wall Street labels out a correction. A 10% drop may not be that drastic, but it's enough that people start asking bigger questions. Is there a problem with the economy? Is my job okay? Is my future going to work out? You really do start getting into a larger set of questions once the S&P 500 has lost 10%. About 86% of all sell-offs over the past 70 years fall into those two buckets. If there's a sell-off, it's a 5 or 10% sell-off. 86% of the time. 60% of those end before even hitting 10%, and 26% are going to stop prior to reaching 20% off, 20% down. So this is kind of where sell-offs live. A significant sell-off, 5 or 10%. That's about average for a significant move down for the S&P 500. If you're investing for a long period of time, those drops are just kind of blips on the radar. These are the blue dots are the 5 to 10%, and 10 to 20 are the yellow dots. And you can see they do tend to trend together. They get in little groups and move one direction for a while, and it happens over and over. So, but when you zoom out and you look at the bigger picture, they really don't do much. They can feel like crashes. Mostly because they tend to come out of they come out of nowhere. One bad yen carry trade, which we just saw, a few pieces of data that don't match what the expectation was, or a COVID outbreak, and bam, we're off to the races. Everything's moving. And they can materialize regardless of how strong the economy is or how solid the investment picture looks. Sell-offs can also, again, lure you into rash decisions. And every time this happens, you'll hear somebody screaming that the world is coming to an end. But in the real world, about a third of these drops don't even last a month, and a month is really nothing in the grand scheme of things. So if we're below 20%, and we're between usually 5 and 10%, those are moves that will get everyone's attention. They will get everyone talking, but they don't necessarily mean anything. Usually, the market keeps on keeping on, whether that happened or not. 20% move. That's the oft-mentioned but rarely seen market crash. Things are starting to get serious now when a sell-off approaches 20%. Wall Street calls it a bear market. Almost everybody else calls it a market crash. It doesn't matter what you call it, how you label it. One way or the other, this really did start. The move did get larger. 11 times the stock market has dropped 20% or more, ranging from 22% down in 1956, that's post-World War II crash, and 57% down in the Great Financial Crisis. And with drops that large, it's not just the dollar value. The market frequently falls this much when the U.S. is dealing with some other sort of economic crisis. In fact, 7 of the last 10 crashes have overlapped with recessions. And crashes do become very painful because they affect not just your portfolio, but also your income, your daily life. You can't escape these by logging out of your brokerage account, and you can't just not pay attention and not look. You can, if you just stay off social media, it's not going to help you. These become huge media events. This is when the market move is deemed quite serious. So there are far fewer of them over time, and as you can see, they don't really have a significant lasting effect, but it can affect portfolio values enough that it really affects what it is you're doing. It'll affect your purchasing decisions. It'll affect your decisions on whether or not to change jobs at a given time. It really does raise the tension level and can change the economic outlook in general for the entire country. And crashes can last a while too. Six crashes, the drops lasted over a year, and 7 of those 11 took more than a year to recover. It can take a while once you have that 20% or more move, both for the drop to get done, and then it takes sometimes an equally long or longer time just to get back to where you were before. You shouldn't let market crashes scare you out of the market, though. In a way, crashes are when the Wall Street numbers really start to look a little bit more normal. 20% off on the downside, that's significant in most realms. If you're back to our clothing example, if all of your clothing choices just went 20% off, now everything looks a little bit better. If you're looking at if you're looking at clothes, that 20% off sale, that may get you in the store. 1%, not going to move anything. 20% off, okay, now maybe we're talking a little bit. And crashes are inevitable. They happen about once every 7 years on average. So we're all likely to encounter a few of these in our investing lifetime. But with plenty of patience and a little bit of luck, never discount luck, they can be just remarkable buying opportunities. Imagine in the great financial crisis, there's a 57% sale on your favorite brand. I mean, honestly, you would impulse buy stuff at 57% off. If it's 57%, if you don't even want it, you may still buy it at almost 60% off. And that's where stocks were after the great financial crisis, when we had the big drop along with the recession. Why should stocks be any different? Why shouldn't we look at it the same way and say, hey, you know what? This is probably a really good time to make a buy here, but we don't. But that's one of the things you should think about when things are bad. Find that spot that looks like it may either weather the storm better, excuse me, or it may be coming back just as strong as it was before. So don't discount that completely. Those are the times when you have to make a decision about those things. Numbers are how we make sense of the world in investing. But again, never forget they are meaningless without context. So with that in mind, how about this number? The most important number is 8%. And that's the average return you would have gained per year if you started investing 7 decades ago. Now, we actually hate stats like that here at Investor Resources, like that last one, because you can't start investing 7 decades ago. And Wall Street is really good at putting those numbers up there to say, see what you missed? You should have just been investing, and 7 years ago would have been a great time. Well, we would rather tell people you can start investing today, or you can improve your investment strategy today. Investing will pay off if you have patience and resolve and a disciplined approach to the market. You're going to have to do a little bit of number crunching to make this work for you. And if you don't want to do the number crunching, you can leave that part to us. We've got you covered there. But just don't forget, don't let the numbers push you to doing something your strategy says you shouldn't be doing. Don't move too quickly. Don't move too slowly. That's where those rules come in, and that's why we are rules-based. That's why we are trend followers, because we never try to predict where the market's going. We watch what's going on, and hopefully we can follow that trend.